So that brings up another topic that we set out to discuss, which was financial engineering traps investors should watch out for. And we have really these wealthy and smart multifamily investors understand that IRR can be manipulated. What I'd like to do is take a look at some actual scenarios of deals where, I think you even said it earlier, where it could just be the timing of the money that comes in, but also the assumptions made on the expectations of even hitting that 10% or 10% cash on cash. If it's like, we're going to get this much in rents and there's not going to be any downtime to,
right.
So those are the gaps that we're trying to fill to hold those. So let's start off with the IRR. Tell me a little bit more about how you see this and how it can be manipulated. Do you even put it in your projections?
I used to.
So you're not even talking IRR to your team.
Yeah, I think, I have a lot of investors that, if anyone really fully tells you they understand IRR, like they're either in finance or whatever. So basically what I say to simplify it, it's the time value of your money. And so the way that you can manipulate that is either the money or the time, right? Like those are the two variables. So
everybody should know how to do a T-bar.
That's right. So what I would say is, here's be the best example I could give. Let's just say, somebody's coming in, and they can raise a lot of debt. So they can do CapEx through debt. They can raise it. They have access.
They can get lines for that.
Lines of credit. I've seen that happen a lot too.
And then all of a sudden, the timing of those improvements are important, because if you're paying the cost of that premium debt for the CapEx, or even construction, is more construction than anything else.
Like one question I told an investor the other day, he was really excited about this group's IRR track record. And I said, hey, just ask them, is the equity going in at the exact same time as the rest of the capital? Right. So,
all right, let's break that down again. Is the equity going in at the same time?
At the same time, and all of it,
as the rest of the capital.
So what you'll see some groups do, because they boost these IRRs, right? Because that helps in the capital raising, right? And institutions are notorious for probably doing this a little bit more, but they'll raise debt, they'll have lines of credit, they'll have other tranches. So they'll buy the asset, they'll use certain debt to do some of the value add stuff, fix it, right, whatever. And they'll burn through those first, and then they'll call the capital. They have callable capital. They'll call it in. So let's say that they held the deal for 2 years. They could buy and do all this for a year, call that equity in, put that in equity. That equity's in there for a year and 1 day, sell it. The gain goes. Yeah. Now we're running the numbers off that capital being in there for 1 year rather than.
So you're a family office, you're a wealth manager. You just had a capital event in that you sold a business. You're sitting on this cash. You're seeing these deals. This IRR conversation. Where should they go with that? I mean, should they even factor it?
Yeah, I mean, yes, they should just understand where they're at in the risk parameter, right? So meaning, if the IRR is good, I mean that's a true number. If you're hitting a high IRR, like that's your time value of your money. Right. So if you're hitting it,
but on a specific deal that relates to a deal that you're going into, right? Because they can have an IRR on a value add deal different than an IRR on a deal that just in Scottsdale.
Yeah,
that drove up.
You want to understand the risk of it, right? So if you're showing me a 200-time IRR, like, man, that looks great, right? And everybody does the math, and you're like, yeah, that would be great.
And then that investor has expectations on that math, because they may not even be telling them about those expectations, but the investor does their own math themselves.
Yeah, and so, but just understand, like, hey, I'm putting equity in, but what if the market turns, or we're overpaying for this deal, or where you just have to understand when and where your money's going, where you fit into the deal, and if you're comfortable with all of that, then great, But there'll be a time, who knows when, where there'll be a turn, right? And the last person holding the bag is the equity, and so that's where you'll hear the story of, I've had my equity in the deal for 6 months. What do you mean? not to get too much in the weeds, but let's talk about like loan covenants, right? So one of the things, the topics that was coming up during COVID that people weren't talking about is people were like, hey, we have this floating interest rate debt, we have whatever. Well, we have a thing called the debt service coverage ratio, right? Lenders will write to a 1.25, 1.3. Well, each lender will have a provision in there that if you fall below a certain debt service coverage ratio, it triggers an appraisal, right? So,
by the way, you get the bill for that.
yes. So there was an investor of mine who was in another deal, and he thought that basically he had lost 10% of his equity at the time, right? Because the property was down 10%. And so from simple math, let's say it was 10 million. Now, the equity came in 20%, so they put $2 million at the 10. Now, all of a sudden, if that value drops down to 9, that lender still wants the equity to have 20% of the deal.
Yeah.
So now 20% of 9, right? So not only he didn't lose 10%, he's got to come to the table. He's got to have a cash call for $1 million, right? So that's the stuff that, fortunately nobody's had to go through.
What's the question they should ask, I guess?
Well,
is it more of the attorney?
So again, as people, credible groups aren't going to be running it like very high, or they're going to have reserves with debt service coverage ratios. But I see deals where guys will come in and you run the numbers and the debt service coverage ratio is 1.2, and you're like, well,
Well, and everybody gets excited too because things are moving fast now.
Right.
They're excited, emotional about the speed, missing out, like you said, just getting the deal, just trying to get in. And all across the news too, we understand that the safety of multifamily as well. So I would assume these sort of questions, people aren't asking.
Yeah, I mean, people get the PPM, right? The private placement memorandum, and that tells you, 100 pages of ways that they can lose all of your money. But it also tells you the fees. It tells you where you fall in the capital stack. It tells you the lending terms,
right?
The rate, all of that stuff. So it's really the blueprint. So like I tell investors, like, read this, like, go through this, like, ask these questions, because it should make you uncomfortable. You're going to see language in there, and it's going to scare the heck out of you.
And people focus on the business plan, right, in many cases, which doesn't
quite highlight all that. Maybe, hey, we'll do this range, or you'll see maybe where the business plan will say we're going to get fixed debt, but then the fixed debt, the 10-year treasury climbs, the debt climbs up, and now this sponsor switches the debt to a variable rate last minute and has the full right to do that. But that just changed your whole deal parameters on whatever. So again, all this stuff goes. It's just being an investor and being comfortable with that particular deal, that particular sponsor.
Yeah. All right. So we talked a little bit about track record. My question was, when you're looking at these deals, what are the questions you ask about track record? And we talked about deals when the money comes in. What other things should someone that's not an operator, they're looking at multifamily deals, what are the questions they should be asking? You mentioned NOI growth. What else about the operators?
I would say to start simple. So oftentimes, people see the business plan. The business plan is going to show growth because there's NOI growth, right? I mean, I haven't seen a business plan yet that basically says, hey, we're going to buy, cap rates are going to compress, and we're going to sell, and we're just going to do nothing. I'm sure that's happened, but that's, nobody's putting that on paper. So it's understanding how they're going to grow the NOI. So the example I used prior was, investor, there was a deal that I was really hot on in Texas. I lost out to a crowdfunding group. Investor got sent it, and he knew that I was underwriting. Well, they outbid me by like $2.8 million. And so we went through the assumptions. We both thought there was $200 of rent growth. We both thought we were very similar in CapEx dollars. The difference of how they got there and the difference in the business plan was their year one pro forma. They were doing all of that and maintaining 95% occupancy, and I underwrote 76% occupancy. Meaning, if we're going to do these major renovations, like, they can't live there.
Right.
If I'm going to gut this place, it doesn't work.
Pretty aggressive, yeah.
So the investor, if you're new or you're a novice or whatever, go through the story. Do you believe it, right? Does this all make sense? If I put a washer dryer in and I get $40, yes, that's a straight line deal. But what if you told me it's going to take me 2 weeks to put the washer and dryer in because I got to drill through a patio and plumb it, and then what happens to the resident? Well, how come now show me that your occupancy goes down? So just kind of follow the story. Now, you have syndicators of syndicators, and that's a whole other thing that's going on out there. You have syndicators who aren't operators, like understanding the operations. And so any investor, I would say, start with NOI, and then have them walk you through the NOI growth. And don't just buy, hey, we're going to get a $50 pop by spending $1,500 by putting baseboard in and a fan, right?
Right.
Like,
When, how?
How?
The current residents,
Right.
are they moving out? Are they giving notice?
are they wired? Like, do you have to drill through the walls to put the fan in? Like,
Right.
how old is the building? You know, whatever. Like, how disruptive is it going to be? And then go, if I was living there, how would this work? Right? So now, are you going to incentivize that person to stay? Like, there's a cost.
Well, so in my opening remarks, I talked a little bit about, like, you know, the economics or the fundamentals of how we put these deals together they haven't changed a lot, in the rates and markets change and all that, but really the customer is changing. Access to the customer is changing. What they expect, and even the idea of American dream of owning a home, like that's even changing, right? So the demand for renting creates more flexibility for lifestyles, all those things. Do you see the syndicators putting enough effort into that story, that what you just went through, which is like, okay, imagine myself living there. You're putting your office in an apartment. You're literally surrounded by your customers. I don't hear a lot of syndicators doing that. I mean, that's Intel.
Right.
You know, one of the best copywriters in the world, from, you know, the big ad agencies and everything. I mean, they would literally ride on buses and trains and go where and enter the conversations that the customers were having, so then they could create ads that, you know, were compelling to them. And that was very smart, to get down where the customer is that's buying and renting the apartment. Do you see that as part of the role that a strong syndicator?
I mean, I personally will never own a unit that I wouldn't live in if I had to or needed to or whatever. I mean, I've literally have stayed in every one of my deals multiple nights, right? From, okay, we got a noise issue. Oh, the AC is what? Because again, we're in a frothy market. You can do no wrong, but there'll be a time where we have to compete on product again, right? And so we talk about this a lot internally. Like, this is where we're focused on right now, is how do we create the best community, right? With whatever that is. So, and oftentimes I think it starts with the property manager on site, right? Like, that person creating that culture and whatever. That's a whole different discussion. But as the market, if the market or when the market changes, and now renters have a choice. Right now, renters don't have a choice, right? They're calling and they're saying, "Do you have anything available?" It's like, call us in September, right? Like, it's a tough deal. Well, when that changes, and now we have 10 one-bedrooms within 500 yards of each other with 4 different properties, who wins that resident, right? Like, where that resident, you know, and you go back to COVID, where all of a sudden that tour was gold or whatever, or however the inquiry or whatever, because you went from getting 20 inquiries a week to not one in, 2 months. You started thinking about, like, you started hearing the managers talk about features of the apartment again, right? Not like, hey, we got one, it's 600 square feet, it's on the second floor.
Right. Yeah.
It's going to be right here. You want it? Like, now it's, hey, we have this refrigerator, we have this, we have 2 pools, we have
the morning sunshine, all that stuff. Yeah.
Whatever. Like it. So, and we talk a lot about that, like in the development stuff that we're doing now, and like creating that right now you can build boxes and you can go and there's demand, but long term, talk about preserving the capital. Well, that's one way that we do that for the investors, is that we're going to have a product that we feel is superior.
So when you're seeing these projections as an investor, I mean, really go through that. I mean, your brand, you talk about apartment communities, but really building community anyway.
Right.
It's like the airlines, all the assets and the airplanes and all the moving parts and maintenance and everything around it. Then there's that other business that lays on top of it, which is the miles programs, which is probably, I think someone told me, more valuable than the actual airlines.
Right.
Access to the customer again. But when these investors are looking at these pro formas, business plans, trying to avoid the traps of where it could be financially engineered or not misleading with intent, but literally where if you're not asking those questions like, the NOI growth, or how exactly are you going to drive that NOI, or how is that rehab actually going to take place, and then putting yourself into the perspective like you did as a customer, do you see that role as I know I talked about the syndicator having the understanding of the deal mechanics, but what should investors expect? Because you're kind of you're not trying to be the biggest in the country, right, but you're winning where you are. What should these passive investors be expecting, I guess, from that? And where does it draw? Like, do they do this due diligence? Do they go?
I invest in a lot of different LPs as well, right? So it's a timing thing. There'll be different groups that I know. They'll see a deal.
And that's based on how you want to live your life.
Right.
That's...
Or I'll have friends in it, and they're doing a deal, and I want to support them. And, I know the track records. But, when I was first beginning, and then you're just trying to get different investors, and they're sitting here, and they got 3 business plans in front of them, and this one says 7%, they're all just looking at who's got the highest number.
So you're looking at the cash on cash, or IRR, and you're comparing these deals, and each has different sponsors, and one understands the math, but the other one understands the math and the community story, and has a better understanding of the execution, but it has a lower cash on cash return. Which one are you picking, right?
And I tend to lean on the operator, on the operations, right? So if the syndicator has an in-house management company, sometimes that's good, sometimes that's bad, right? It just depends. But I'm looking at, what else are they managing? Who is this group? And again, I will invest in the story, not the number. The number's important, that's what gets your interest. Yeah. But, I think about every deal that I have that has not, or that I've invested in that hasn't gone to plan. It was the biggest number, right? It was the best looking business plan one there was. But the ones that were gosh, I think you're undershooting yourself there. I think you could turn 60 units this year, not 30, right? I think you're going to get more there because these comps, they're so much higher. And I don't know if they're that much when I invest in the story, it goes very, very well. When we develop, that's what developers do, right? The really good ones in town,
right?
They have been doing it for a long time. You'll talk Mark Taylor, Scott, when they went into a piece of property in town, they'll lead with the story, right? Mm-hmm. We have this many jobs growing here, this influx, this supply. Here's what the houses cost. Here's the delta, right? And they would develop around this story, fill the niche, and it would go well, right? So that's now when properties are changing so fast and they're just get them. It's hard to develop a story. But now you'll see a business plan too where somebody might say, hey, this is just going to be a blue chip property, right? It's a tight market. There's not much rent growth. There's not much to do. Maybe there's some lipstick to it, we can paint a door type thing, but we just think this is going to be a good area for 5 years and this is how we're going to cash flow. Okay, great. Now, does my debt reflect that story? Does my equity reflect? Does everything match the story that you're telling?
Does your capital stack match that story? And so let me give you another scenario. Well, give me a scenario. Somebody exits a company, or they're doing really well, and it's no longer how do I make the wealth? It's how do I get it to work? And they are focused just on yield, and they are just keen into that one element. You had mentioned earlier in another conversation around invest like you're broke. Because if you're just chasing the yield and you only look at the yield, you may go after the wrong deal that doesn't have the right story or the right operator to put together the true realities of pulling off a reposition. Because in your story, let's say you're throwing off a lower return because you factored into, like you said, 76% occupancy dip because you understand, like, okay, this is going to happen. This is the story behind this improvement. If you're just seeing yield, you miss that. Why should investors invest, even if they're sitting on, massive capital, as if it's their last?
Well, because it makes you pay attention, right? Like if you're, I would rather lose my own money than my investors' money, right? I would, if you have only so many shekels, it's so important to you that you get that back, or it's so important that those grow. What happens now is I think you see guys looking at tranches of money saying, that's not doing anything, if that's not working, that's whatever flyer, like you're doing this. And that all, again, that works great in the up market. It works good in probably like a steady market. But when something changes, then everybody needs that capital and they want it back. And then all of a sudden these questions start coming up again, right? Like, well, what happened here? What happened there? So, we look at each deal, we go in, we have people that trust us and give us dollars, which is a wild thing to think about, right? Like they're like, here, go, grow it. And they can use that money for lots of different things, kids, school, whatever. Like, so we have an obligation to, to grow it and to give it back and to protect it. Now, there's things that will happen that we can't control, such as maybe a market condition, what just happened here, whatever. Like that stuff happens. Investors know that going in, right? Like every deal has.
And everyone's risk in that scenario.
Yes. But from an operating standpoint, if you operate like you don't have a lot of capital, so if you're doing your improvements, you're really maximizing that value. Now, you want to be careful too that if you're going with a new syndicator and they don't have a lot of capital, or it's hard for them to raise capital, that that you're not undercutting it too. Meaning, like, gosh, if you just had an extra $1 million, you could go here, or we're not quite fixing this or replacing this in the way that it needs to be.
Pay now or pay later.
Yeah.
Yeah, that's definitely. I don't know. As a syndicator or a sponsor, what education are you guys doing? You just have sort of your conversations about these programs. How much time are you spending in that story compared to the actual deal points?
Yeah, the operating company and the management company has phenomenal data, right? So we're looking at that every single week. The plethora of investors and deals and the guys that are investing in different parts of the country, we're in that, every single week. But we're not good at projecting. I think guys can project fairly decent, 2 to 3 years. I think, and you look at these business plans, sometimes they're 5 to 7 year projections. And quite frankly, like, who the heck is going to know in 5 years? And so that's another thing, like where you're looking at the pro forma and it's like, you got crazy rent growth in years 3 through 5.
Right.
Like, that's amazing. Like, how do you know that? But with data, we can project the next 2 years with some pretty good certainty that we're going to have some rent growth, whatever. After that, it's a wild guess. So, there's all these little things that you can go into these pro formas that get people's numbers where they're at. And that's where, if you fall in the story, and I know I'm getting off track on it, but there's this, I see all these scenarios, where you go, okay, I have $100,000, I'm going to get 200 back in 5 years.
Right.
Well, really, if you look at it, that 200 goes from 100 to 200 in years 4 and 5, because the first 4 don't do anything.
And we don't know much about year 4 and 5
right,
as it stands.